friends, this is Martin here from Secret, the channel for learning about trading and investing. Welcome to another new episode of the markets next week, and this is analysis for December 6th, Monday 2021, where we look at the markets, what happened in the markets last week, and how we can plan for a better trade tomorrow. So if you're not subscribed, please subscribe and share it to friends and colleagues so that all of us benefits. So here is the price action and the patterns. The charts are ready. Let's go through that. What happened last week? 4.2% of recovery happened from the previous week's dip, and Nifty managed to close 1% up from the previous close. Look at this, right? It had taken a big dip, and then there is a recovery that has happened on the Nifty, and the same. It had a big dip since last several weeks on the Banknifty, and it has taken a recovery and ended with it's a doji candle. Doji is always indecisive, and here is a green close, but no. So what exactly happened is it's a 4% on Bank Nifty recovery, 4% again on Nifty recovery, but managed to close only 1% from the previous close. Similarly, 0.5% only from the previous close. Right? You can see that indecisiveness there in the Bank Nifty. But if you look at the last daily candle, you can see that it's bearish, right? Look at this. This is the daily candle. You can see that this is clearly a wide range bearish candle, and here also it's a bearishness that is there, right? So how much is that, right? It's a 300 point on the Bank Nifty that's bearish, and Nifty is 200 points dip. So the last day's price action was not good enough, but otherwise the recovery almost completed a V-shaped recovery from the last. This is Monday, Tuesday, Wednesday, Thursday, Friday. So this, the previous Friday to the next Friday, it made a full recovery on the Nifty and Bank Nifty, but Bank Nifty just slightly gave it up after the recovery was complete. This is exactly what happened, right? Now, if you look at the Bollinger Bands, you can see that obviously the volatility is expanded on the bearish side on the Nifty and the Bank Nifty both, you can see. So that's clear indicative of a high volatility and bearishness evident, right? Now what else do we see here, right? So we need to see the support resistance level. So we have the support resistance level put here, but let's see them on the charts here. This is of Nifty. So what has happened is it has taken a support here at 17,200 17,300 range, and if that is broken, then you're back to the 17,000 to 17,050, which is the previous swing low once it had taken support before that 2 days back. And if that is gone, then you have 16,900 Fibonacci 38. Fibonacci retracement is there, and if that is also given up, we have the gap support. Look at this is a gap, unfilled gap, and then that is at 16,700, and that seems to be good support. If that is also gone, then it goes back to 16,550 to 16,650 kind of support levels. But the upside, what do you have there? 17,350 to 7,400 is the resistance on the upside, where it is slightly managed to close above that, and then above that you have the major resistance one is 17,500 to 7,600. So 17,500 is conquered, means then you can, that's only time when we can look for a recovery in the full sense, right? As long as it is resisting below this, it's going to be consolidation, not even consolidation. There is every chance that it can make a lower low and then further move down. So a green close above this 17,500 resistance is very important. Now after that is taken, the next resistance upside is 17,800 to 17,850, and after that you have the 17,950 to 18,000 range resistance. The 18,000 is a rounding number, good resistance level. So after that you have the previous resistances were placed 1800, 18,200 and 18,400 all in the way, right? So that is the support resistance zones that is mentioned here, right? So the Nifty 17,200, 300 seems the first support, 70,000. So that's what is put here. Previous swing low and previous resistance. This is 70,000 is a rounding number. Previous swing low, swing resistance, and this is a gap resistance. On the Bank Nifty, what you have here is that it has taken a support at 36,300 to 36,500 level right now, and resistance is clearly evident at 36,600 with the first one. Above that you have 36,900, 37,100. So 37,000 is going to be a major resistance upside. After that you have 37,300, 400 range, and then we have the major resistance that's going to come at 37,800 level. On the downside, you have 35,600 to 35,900. It's near to 36,000 is going to be the major support zone. If that is broken, you have a problem. Downside, you have 35,300 after if the 36,000 is given up. Then you have the 34,350 to 34,750. That's exactly what is putting here. Banknifty. Fibonacci 50 is what the first support is at 36,300 to 36,500, right? And the support that if that drops further, there's a previous swing low and previous resistance zone, and if that is also gone, then you have Fibonacci 61. So any breaking of 34,000 is going to be really worrisome for the Banknifty support, right? Resistance on the upside is 36,600, and which is the previous swing low, and right, then you have the 37,000 that has to be taken out, and then you have 37,400 kind of level. So that's the support and resistance zone. These levels has to be kept in mind when you're trading long or short, right? If you're positionally long or swing low, swing long, then you need to know what time you need to get out. So these levels are very critical. You need to also know what time you need to enter if you're going to go long ever. Right now, long is not an option at all, right? Because it's bearishness all around the charts. Let's move on and see what is the momentum and the trend analysis. Momentum, it's clearly in the bearish zones on the daily and the sideways zones on the weekly, the medium term. Banknifty, if you see, it has also lost the momentum on the daily and the weekly also. There is also in the sideways. Last week it was already moved to the sideways and it's not recovered above that weekly as well. So so that's, but monthly, if you see, the monthly is bullish still. That's monthly means it's a long term. Both the indices are bullish, but short term it's bearish, and medium term it is kind of sideways as of now. One thing to note, that there is a forward bullish momentum divergence that can be seen. Look at this. This is the monthly chart of the Nifty and the monthly chart of the Banknifty. You can see that the price is moving up and the momentum is coming down, right? So that is kind of confirmed because it is moved about that. Whether it will move up, so if it is moving up, it can take it back to the all-time high, right? Same is happening in the Banknifty also, right? Price is moving up and the momentum is moving down. It's bullish reverse momentum divergence, right? And remember that this is monthly, so in order to get things to move, it takes a month. It's a long-term divergence that you're seeing. So the long term, it clearly shows that it may be bullishness, but medium time, then maybe slight consolidation is what this momentum divergence is indicating. This is not for a trade, for intraday, so you cannot understand this divergence and use it and apply it on a intraday or a swing, small few days or few weeks of trade. This is a monthly, so you got to look at it that way. Otherwise, momentum on the daily, you can see that this is something good on the daily that you see on the Nifty. You can see that there is almost a range shift that is happening from the sideways to the bullish. This is normally bullish because it will take support at this range and then it can bounce up long way upwards. But that's not the case in the Banknifty. You can see that here you have a resistance that is saying it's taken a bent momentum. It's still in the bearish zone on the daily. So Nifty has recovered into the sideways zone on the momentum, and Banknifty is still in the bearish zone in the short term. That's the story on the momentum. And you have a long-term bullishness that is still seen on the monthly and the Nifty and the Banknifty both. Trend-wise, if you see, you can see that it's still Demat negative dominating on both indices, Nifty as well as NIM. And you can see that it's taken a bend. That means that the bearishness or the Demat negativeness on the charts is slightly decreasing. That means there is a chance that it can cross over now after a few weeks. Same here. It has taken a bend, means bearishness has reduced. The strength or the quality of this bearish trend is slightly reducing. That means it can go sideways and then eventually to bullish. But overall, as of now, the trend is bad on the short term. Now let's move on to the volatility. Volatility has broken out of the 20 range and hit the 21 previous week. But look at what happened this week. It has dropped off. Nearly 13% of drop was happened. It has settled at 18 point, what is that? 18.45, the range where it is. So volatility has cooled off last week. That's what happened, right? And the IV implied volatility 16, which is greater than the historic volatility of 22. which is fine for the selling, but IVP has dipped from the 52 back to 42 kind of levels, right? So yeah, so IVP has fallen, IV has fallen, and VIX has cooled off basically, right? That's what the volatility is showing. So VIX cooling off is good, but would it again go above this 20 level is concerned, and this range may, if it is falling further, it may hover between this 20 range to below the 15 kind of levels, right? So open interest, the next thing that we'll look at. Open interest, you can see that the highest support put writing is happening in 17,000, and after that we have 16,000, which is very wide. It does not give any clues. That doesn't mean that it can fall to 16,000, may not be. And this is, remember, it's for the December expiry, a few days away. So there is some uncertainty in the market is what it indicates. People think that it can fall to 16,000 also, right? Even when just 4 days are left for the markets to go to an expiry. Now resistance upside, if you see 18,000 and 70,500 is where the call writing maximum seen, which is reasonable. But 18,000 call, yeah, highest is at 18,000. That means markets also expects that the bounce can continue. So look at the ranges of 16,000 on the one side and 18,000 on the other side, which is, you know, that's almost 800 points away, 18,000, right? 1,000 points and more below on the downside. So people expect anything can happen, right? That's why you have maybe hedge positions also. But if you look at reasonably, 17,000 is going to be a good support zone, and 7,500. So probably the expiry may be between 7,000 and 7,500. If there is no big crash, that's not going to happen, right? And open interest strategy showing long unwinding, which is bearish. Again, people who are long have moved to the unwinded that and moved to the short. It's bearish, and the short build up obviously on the Banknifty. And 0.64 and 58 is not bullish. You can't say it's bullish on the put call ratio that you are seeing there, right? So that's the open interest analysis and the volatility that's giving us clues. And this is what the open interest analysis is saying. Look at the huge call writing that has got added up here, right, on the Nifty. Some unwinding has happened at the 17,250 kind of levels, and put writing has got more added up, and then leads us to think that 70,000 may be the support. Banknifty also, overall you can see that the graph is more of bearishness because maximum call writing is what is dominating. And here also you can see that a lot of additional change in open interest to the call writing additionally has got added up here last week, right? The greens are all call writing. That makes you think that 36,000 holding may be the big task for the Banknifty ahead of the expiry next one. Let's move on to see what is the sectorial performance on different industrial segments. IT sector recovered the 3.5% overall if you look from the previous week. If you see, momentum is still continue to be sideways on the daily and the weekly, so we'll have to wait for the long positions or stock picks. FMCGE has slightly up 0.5%, right? Daily is still in the bearish zones and weekly is sideways. We'll have to wait. Metals 1.5% up, and up on the weekly has slipped to sideways, and short term is also sideways. So we'll have to wait for the longs for swing trades, long positions I'm talking about, not long term. Auto sector 0.5% down last week, and the short term momentum is bearish, and weekly also it's sideways. So we'll have to wait for the momentum to catch up. So pharma 4% up, and the momentum short term sideways, and reality also slightly up. It's hardly 0.5% up in reality. So short term momentum is sideways, and so basically, in a nutshell, there is some greens that can be seen across all the sectors last week, but unfortunately the momentum is either sideways or some of them it's in bearish zones on the short term or the daily. So we just have to wait for the short term momentum at least to catch up in, and it has to be in the bullish zones above 60 RSI before we can think of position of swing trades on the long side, right? Until then, just hold on until you get the confirmation that this. Otherwise, you may have surprise worse that may happen. So that's about sectors. Next is institutional participation. Look at what Fyers had done last week. 15,800 crores of selling in the very first week of December. Thank God, domestic institutions about 17,500 crores last week, and that's how we recovered. So it's exactly the domestic institutions that saved the market last week and facilitated the recovery basically. right? So net long on the derivative side also for the FI and DI is also gone up. So FI is selling, it is continuing the entire last 3 months. This is the third month of heavy FI selling that continues to be there. Last entire week they were selling. Look at the volumes. They're not selling in small volumes, 2,500, 3,500. That's the kind of crores of selling that is happening in the cash. This definitely means that the FIs are taking the profits, taking the money out of the market, due to probably worries on the COVID or worries on the tapering. So it gives a doubt that liquidity rally may also be over. But given that the COVID fears are back, the tapering may not happen, and it should uh, ideally bring back the FI money back to the emerging markets like ours, right? Hopefully, yeah. So now let's jump into the global markets and global commodities. Look at what is happening in the currency pair. It's right on the top of the channel and trying to break out of a major resistance zone, which is about 75, and it has tried that multiple times, 75 levels, to break out of that. So there is some kind of intervention, then market goes back every time. I hope that the same thing happens for the next week as well. There would be some RBI intervention or some resistance may take place at this level, and and then it can drop off. Meanwhile, the US dollar currency index, you can see that it's breaking out from the second major resistance level, but it is in a slow mode or a consolidation mode. You have two indecisiveness to decide whether it has to further move up and then go hit at the 99 kind of next resistance level on the upside. Now, US markets overall, if you see last week, 1 to 2% of fall has happened following the COVID surge panic, right? All of the indices, Nasdaq, S&P, and the Dow Jones all closed at 1 to 2% fall. The dollar index, we already talked that it is kind of indecisive and consolidating, but it is broken out of the major resistance zone, and it is having great momentum, and it is bullish. USDINR currency pair has also weakened the rupee last week, but it is kind of taking a resistance at the channel top and also a previous major resistance zone as well. Now the good thing is that crude oil has cooled off 3% further, and it has gone to 66 kind of levels last week. The total 22% of drop from the 82, 83 kind of levels in the October end till now. Right, 22% drop is very good for our economy, Indian economy. Gold, meanwhile, you can see what's happening in the gold. Gold is fallen. It's also kind of consolidating. So this is the crude left side that you're seeing. Look at the fall, right? 22% of drop, and then with the channel edge. Gold, as I said, it has taken a hit on the channel top, major resistance on it, 1876 kind of levels, and it has dropped up, and now back to the support zone, the major support zone. It's consolidating, and last week it was kind of small body indecisiveness, but overall we can say that it's a weekly cup and handle pattern that you see. This channel is actually the handle of the cup and handle, right? So it may take a while, but overall it's bullishness in the gold. Two stock picks for the next week. It's not recommendations, but the charts are educational to know that there is some up move and down move that can be expected from each of this. Data consultancy, if you see that, you can see that it's a clear breakout that happened from a resistance zone, and it has come back and again taken the support. And this channel, weekly channel, is very well respected, and then it has dipped and taken a bounce from there, and there is a long way up. So TCS can be a long play, and IT is defensive when our market is consolidating or bearish. I know IT sector normally performs. Right side, you have a bearish setup, right? And that is I need to check what was that stock that is identified. It was yeah, so that seems to be, let me just check quickly what is that. Right, anyways, let's ignore that for the now and proceed with the next. So this is the index payable actionable. Yeah, so what you see here is a bear put which is it's a debit strategy, it's not a credit. So you're seeing that the 17,800 put option is for the December 9th expiry. The next expiry has been bought in, and what we have sold is a lower expiry of 17,200. So we are put. So you can see that the downside is completely protected as so. So there is a cold fear, and there is panic, and there is heavy resistance around 70,500. So in case the market falls downside, it's fully protected. You get to gain 7,000 rupees. So actually, it's a reasonable risk reward, right? And upside is where the resistance is there, and then as long as it's not going above 317,350, we are safe, right? You can do the adjustments or you can exit early. It's up to you. If you have to do the adjustments in case market is moving up, you'll have to close the profitable position and then push that put option further inside, right? So this is the probability of profit is okay, and risk reward is also okay, but the main thing is that in case of a crash, you're protected. So that's the actionable on the index Nifty. Now just to wrap up, the markets this week, as we know, it has recovered from the previous week's extreme bearishness that we got scared in. It's around 15% and 8.5% of correction is near to 10% of correction happened, and then that really scared, and it has recovered from there, which is good thing. But my bias remains to be mildly bearish, obviously, because the momentum is lost, the trend is lost in the short term. I'm talking about the daily, and sectors are all falling and losing momentum and trend, right, as indicated by the RSI and the index indicators. And then the heavy institutional selling, the Fyers continue to sell every damn single day, right? So so that is a worry. So that's why it's bearishness. Why it is mild is because it has taken a momentum range shift. Recovery has happened, 4% recovery happened, and that momentum range could take support of the RSI 40 and then bounce up, right? And it may be a consolidation ahead and not a crash, right? That's why it's mild, but I cannot be bullish as long as there is some indication of a close above 17,500, which is a Fibonacci confluence retracement level, right? India VIX has cooled off, which is also good, right? Just broken out of 20 and reached 21 level and then cooled off, which is also some kind of indicating that it may not be a big crash happening. But anytime if that moves above the 21 kind of 20 range again, that means we need to be cautious, because we never know when the volatility is going to stop, right? Where is it going to stop? So if you're a seller, then you are in trouble, right? And if you're a buyer also, you never know when it is going to revert back. So and it'll be too choppy. So anything about 20, it's cautious time. Now vertical option spreads like the bull, like the bear put spread that we discussed earlier, is the way to go, instead of going for a naked position and then get trapped with free trades or sudden reversals and all that. Here the vertical spreads like a bear put spread that we had seen earlier, we have the risk that is defined, and then we know what we're going to lose, the worst case, and we have bias based on which side. So we know that our view is bearish, so we have gone for a bear put spread. So if it is bearish, then well and good, you gain. If it is bullish, then you lose a limited amount that we know exactly how much, right? So go for that. Anything about 20 weeks, India weeks, you need to be cautious, because non-directional also may not work. Option selling will have trouble, option buying also may have troubles, because there is uncertainty on where the you don't get the premiums as per your understanding when the volatility is very high, right? The decays won't happen properly. Even the price premium increase also won't happen properly. So you'll be cautious when the VIX is about 21. Yeah, also just like how it was for the last time, long-term investing, this may be a time to get some very good quality stocks at a cheaper price, right? And buying the index ETFs like Nifty Bs or Banknifty and all that also is a good idea, because it can be used for collateral. At the same time, it will give you a rebound benefits when the market catches up, right? So this is a market cycle change that may be happening, right? Right, where the VIX is at a level back to the there is a lot of fear in the market, and you need to get adapt to different strategies and not stick to your one single strategy that had been working in the previous market cycle. So keep shifting your strategies as per the market changes its behavior and changes as per the market cycle change that happens, as per the volatility change that happens, right? That's a wrap up. So this is my view and may not be yours, right? But it may help you to form your own view and your own trading plan in some way. If you like it, consider hitting the like button and then share to friends and colleagues. Thanks for your time. Thanks for watching. Happy trading, happy learning. Bye.